my advice is, number one, understand your capacity. I would say getting into the market now while there are opportunities in people being uncertain.
The property market is worth 12.6 trillion. How can you reduce this market to just one statement?
Property investing is a mental game.
Considering that there's a lot of chatter in the media, a lot of different opinions and so on. Hey guys, hope you're well. Thanks for tuning in. Hey Ali, how's it going?
Hey Roy, I'm great, man. How are you?
Not too bad, not too bad. The weather's starting to turn here in Melbourne. I don't know what it's like on your end, but it's pretty miserable. But it's good. At least I've decided I'm going to start going to the gym after work. That way it's not too depressing because obviously daylight savings is over and it's getting colder. I figured that way get a bit of a positive hit before I wrap up my day. You know?
Yeah, fair enough. I've always loved it early in the morning. I enjoy it during daylight savings. So I think I always told you, one of the things I try to do is wake up before the sun. And it was probably a lot easier. You could wake up around 5:45, even towards 6 a.m. and still be pretty dark outside. And nowadays, you got to probably wake up, probably I think latest when we're 5:15. So the sun's been up before me the last couple of days so far. But it's a good challenge. We've got a couple challenges going on this month. One initiated by you. Yeah.
Yeah, I know. I don't know. I was in a bit of a mood. I was like, you know what? It's nice to be able to work in an organization where we have two physical offices in two different locations. But sometimes you kind of start wondering about how you can bridge the distances, and help the team be a bit more well connected, not just on the work front, but obviously on other things. I figured, all right, we all like to go, we're all into health and fitness, or most of us are. So that's organized this challenge. So we're doing this push-up challenge for anyone who's listening or watching, where we started the month of April with 20 push-ups a day. And then we're adding 5 push-ups every day. And we have to just record ourselves, and we have to do it in one session and then send it to the group chat for everyone. And we're all just cheering each other up, trying to do it. I'm 35, almost turning 36. I've never done 50 push-ups in one go before. I remember maybe doing 20 in my teens, so it's definitely working really well for me. It's nice to also see some people cutting corners and not going all the way down and going deep enough. But it's fun. It's good fun.
Yeah, no, it's good. I think it makes a lot of sense. Doing things that are hard and getting together and doing a physical challenge. Because I think property investing, like we said earlier in the podcast when we first launched our first episode, we were talking a lot about we talk heaps about property, but then a lot about mindset. And I think while you have a challenge in the market, and while property investing is I would say a very challenging thing to do, because there are things that you've got to overcome, and if anything, it's not as physical as a challenge, right? Unless you're going out there and renovating your house yourself, but mentally it's quite tough. And I think I've always said, if you can be strong, in the mind, you can be strong physical, and then vice versa. So now the thing has been really good, and I would say I'm a relatively fit guy, but it's definitely pushed me past what I thought was actually possible, but it's definitely challenged me. So now it was a really good one, and I'm already thinking about the one for April. For May coming up. I think I've got an interesting one. So let's see how we go. I do.
This one first.
Awesome.
I have a feeling it's going to have to do with running for sure.
Exactly right.
So, hey, are you drinking this IM8 vitamins?
IM8, yeah.
Yeah, I recognize the bottle. I've heard about it a few times here and there. How do you like it?
Man, it's good. It's just something I think that makes me, number one, get that water intake. And it's obviously good for you. It's good for your gut. And I think a lot of people that maybe struggle with gut health, like me, it's something that just kind of that you get into a bit of a habit. So our business partner actually got it for me, which I thank her for. And every morning I come in and I kind of put the powder in and drink the water, and then pretty much from there I just keep drinking water, so I'm definitely drinking enough. But it's really good, tastes nice. So yeah, get into it. I think anything that helps your gut nowadays is so important with everything that we're consuming now. It probably isn't that healthy for us, but that's for a different podcast.
100%. No, it's
Not
good.
for a property one.
No. So, with the speaking of property, I got the idea for today's podcast purely off the back of our conversation on Monday and during the team meeting. And one of the boys said, you guys should make a video. I'm like, hang on, we'll talk about it in this week's podcast. So, just for context for everyone who's listening, as you know, there's a lot of chatter around the changes to the capital gains tax and to a negative gearing in the upcoming May budget. Now, although we live and breathe property, we haven't really been too distracted by these headlines. We're just keeping our head down, focusing on the job, focusing on delivering good results for our clients. And funny enough, we had a record month for Buyers Club last month in terms of clients coming on board. Considering the amount of noise that's out there, there's a lot of confidence in the property space, to be fair. Where it gets really interesting and confusing for some is when they hear statements like, the market's going to go backwards, the market's not doing well, CGT is going to tank the market, things like a big statement, sensation, like big headlines, right? And for me, it's just, it confuses me, because how can you reduce a $12.6 trillion market? The property market is worth 12.6 trillion. How can you reduce this market to just one statement? Like, do you actually really genuinely believe that the entirety of the property market is moving in just one direction? There's hundreds of markets within these markets. And currently we're buying across maybe 10 or 15 of those markets as a company, Ali. Yeah. So I figured it'd be nice to talk about this today and share with our listeners how we've dissected this report from CoreLogic. So for anyone listening or watching, CoreLogic is essentially a subsidiary, Cotality is a subsidiary of CoreLogic, and they publish these housing charts every month. So this is coming from a very credible source that a lot of operators in the industry rely on to make informed decisions for themselves and for their clients as organizations as well. Okay, so figured, you know what, let's just have a chat about that. So it's pretty clear. Property market is big enough. We can't reduce it to just one statement how it's going. So we have to go a few layers deeper. So I figured let's just do this together today. And then hopefully our listeners and our viewers will get some value out of it. So let's just kick it off with what's happened in the property market over the last 3 months. And I think this is very important. I wanted you to take the lead on this one, Ali. But I just want to say something, that in the last 3 months, we have had interest rate rises. We have had the war happening in the Middle East for the last 40 days or so. So that's half of the last 3 months, right? And it's very interesting to look at this graph considering what's been happening, okay? So it might be worthwhile, Ali, considering you're our CEO, you also run our property team quite well. And so I'd like to share with our listeners, how do you dissect this graph from your end?
Yeah, one thing that I actually want to touch on, Roy, if you can go back to the first page, I would just want to make one quick point. We mentioned that the property market, Australian property market, is worth roughly around $12.6 trillion. But one thing that many people have to understand is that you've hovered over it, that the current debt is at $2.6 trillion. Now that's obviously a lot of money. But when you put it into perspective, it's almost like saying somebody that has $1 million loan has $1 million property and has a $150,000 loan and is going to struggle, or a $200,000 loan, right?
Yeah.
When a lot of people put it in that perspective, people got to understand that this property market crash that you see is that so many people have no mortgage. So many people have very low mortgages, right? People that have owned properties. If we look at the property market over the last 10, 15 15 years. Anybody that's held a property for really the last 50 years, i.e., probably have very minimal loan and a lot more of a value to debt ratio versus someone that, you know, probably markets like Darwin, maybe excluded, and other, you know, big mining kind of markets excluded, right? Because markets over there have not necessarily grown as much. See, we talk about Darwin being on a bit of an upswing now, but this is something that people, I guess, have to look at, and it's something that puts, when I look at kind of real estate, I put into perspective that roughly people have, give or take, less than 20% debt on an average property, which is so low. So people being forced to sell a property or sell it below market value, or you know, capital gains is going to make a huge dent in the market is probably not, there's not a lot of truth to it. And again, people don't need to sell. I think that's what people need to understand. People don't necessarily need to sell. You know, even if rates were going up to 7, 8, 9, 10%, again, will that shift be there? Will that make a dent? To a certain degree, maybe in some markets where they're highly leveraged, where maybe in some of the newer areas where people have bought houses just, you know, a year or 2 or 3 years ago, and they've still got pretty large mortgages potentially there. But from an overall perspective, always can kind of consider that when you look at the property market worth over $12 trillion and then debt of 2.6 trillion, it's kind of like owning a property with owning a property worth $1 million and having a $200,000 debt and saying this guy's going to be forced to sell his property.
Yeah.
Almost.
Yeah.
From an overall perspective, right?
Yeah.
Of course, there's case by case. So we'll get straight into it, Roy. I appreciate you giving me the lead on this one. I love talking about numbers and I love talking about stats. So I think most important, what we wanted to really establish here is explaining to people where the current market is at the moment. And we're going to explain not just where the market is, but why the market is continuing to show these signs of really, really strong growth. And in some cases, really strong growth, like almost record-breaking growth. So let's kind of start off with, of course, the major capitals. And we've got Canberra in the last 3 months. So quarterly growth has been 1.4%. Darwin, which has been a very, fast mover the last, 12 months, has been 3.4%. Hobart at 2.5%, on that comeback. Perth, which has just absolutely even genuinely shocked me, at 7.3%. Now remember, we're talking about quarterly growth. When we talk about the Australian annual average capital growth over the last 60 years, we average it out to be around 6.8%. So it's done more than that in just the last 3 months. Anything above 6.8% is what we consider a boom market, because it's actually growing above the median. So we're already in boom territory for Perth. Like this year, unless the market goes backwards, which we do not see any signs of that, and we're going to see signs of future growth, it's already in boom territory. So imagine you bought in the market and the property has already boomed for this year. So that's what we're seeing in Perth. Adelaide, 3.6%. Brisbane, again, amazingly strong, 5.1%. Melbourne and Sydney, surprisingly, 0.6% for Melbourne, negative, and 0.2%. When we look at the major regional markets, without getting into too much details, regional Northern Territory, 1.6% positive. Regional Tas, 5.2%, which actually shows stronger signs of growth. Regional WA, 6.2%, again, really strong. Regional SA, 4.2%. Regional Queensland, 4%. Regional Vic, 1.8% positive. And regional New South Wales, 2.4%. Now, I will say this, and it's a little bit of a plug to us, but we have been buying in regional Vic and regional New South Wales for the last year. And even in the last 3 months, I think that this number is still very low. I've seen markets, truthfully, that we bought into. And one of my last purchases was actually in regional New South Wales, has had more than 20% growth in the last 9 months, and I genuinely have seen that in price. It may not be reflective in the data right now, and data does lag, but yeah, I've seen prices move a lot faster. So that's a lot considering interest rates, war. Look at the amount of growth that's occurred.
Yeah, what's just one thing for our listeners and viewers out there? Make sure you watch to the end of this episode, because you're going to see some surprising figures that have to do with Melbourne and Sydney. So whilst they've posted 0.6%, as you dig a few layers deeper, you realize that there are markets within markets, which we are going to be also talking about. Now, what's you mentioned something that was interesting on Monday about Tasmania, Ali. Like if we look at the 12-month capital growth for regional Tassie, compared to the quarterly growth of regional Tasmania at 5.2. You said that regional Tasmania has had a growth of 10.9%.
Yep. So this for us, you have to understand, and I think my point was that there are markets, and markets are cyclical, and there are markets that grow at different time. And what it just shows us is that over a 12-month period, when we annualize the growth in regional Tasmania over a 12-month period, it's grown at, call it 10.9%. But then in the last quarter, it's grown over 5%. Now, what does that mean? Mean the last 9 months, if we exclude the previous 3 months, the 9 months before that, the capital growth for that 9 months was only around 5%. So when we look at that, look at that from a quarterly point perspective, it's grown at 1.6, 1.7% per quarter. So now we're seeing 5%. What does that mean? Shift. Well, exactly right. And what that means for us is that what people need to understand is that sometimes knowing when the quarter has grown, or what the quarters look like from dwell in a little bit deeper, it shows that the market is now growing. It shows now there is price momentum and price movement. So if we looked at this, say, 6 months ago, we might have seen Tasmania only have grown for over a 12-month period, maybe 5 or 6%, and it would have never not looked as strong. So what it shows right now is that in the last 3 months, it's actually allocated more than 50% of its 12-month growth. So it's showing us that Tasmania has now entered into that boom cycle, and that kind of that market pressure or market growth now in that last real quarter. Previously to that, we would consider it a pretty balanced market. It probably just performed just below the average, but now we're starting to see that market shift, and that's exactly what's interesting about regional Tasmania. It is now based on the data, and we look at obviously more than just one piece of data, just for everybody to know. We don't just look at one specific thing. Like, there is going to be a couple of data trends that Cotality does really, really well. Obviously, we look at it more on a suburb level as well. But you will start to see that it is entered, basically, its new growth cycle.
And one thing that's surprising, it's nice to see that the momentum in markets like Perth hasn't really slowed down. So what I'm going to do is I'm going to just share with you the graph on the screen for days on the market, and it's just very interesting to see. So some might say that, oh yeah, well look, if Perth has had say 20% capital growth over the last 12 months, it's probably going to run out of steam. So one of the things that we look at is days on the market. Can you take us through that, Ali?
Yeah, no, thank you. Yeah, 100% right. Like, exactly right, guys. Like, ultimately, property, we've always talked about works of supply and demand, and what we got here, Cotality has done a report where it talks about the median days on market between 3 months to March. But what we see here is the difference between 2025 and 2026 March comparison. What we can see here is that in 2025, Perth, while going through its hot market period growth phase, and it was sitting at 15 days on market, right? Which is super low. Again, a balanced market is around 45 days. So we're sitting at 15 days. So we can understand that the market was going through a growth cycle because it was selling so quick. And it was growing, which made a lot of sense. But right now, it's currently sitting at 9 days on market. It's almost decreased by 50%. So he's selling right now at under 10 days, which is ridiculously low. And when we kind of can use this as a comparison, if days on market is an indicator for how much pressure there is in the market. And if there's pressure, there is growth. And we see pretty much 50% more pressure in the market than this time last year, where it's only evident that we are going to see more growth than what we've probably seen this time last year.
Yeah, because if we also look at the listings, it's singing the same song, isn't it?
Well, exactly right. Essentially, they work hand in hand. Sometimes, you're very unlikely to see a lot more listings and also lower days on market unless we're looking at those major big estates and, land that has been rezoned in specific pockets and people are just flocking to it because of that reason. Exactly right, Roy. When we start to look at the listings, like Perth, again, there's no surprise that Perth has less, negative 14, almost 14%. So 14% less listings than this time last year. Essentially, there is still less supply. And I guess the fundamental point of view is that people have not gone anywhere. If anything, I think we brought more people in, especially during some of this war over in the Middle East. Like a lot of people have probably moved back to Australia and to these capital cities. But we are seeing less than 14% less listings in Perth. Darwin, less than 15% less listings, and then 16% less listings in Canberra. So every market realistically has had less listings across the board from an overall point of view. Some markets have of course picked up, but overall these markets that are seeing a lot less listings, like Perth, are seeing some of the strongest signs of capital growth.
Now, whilst we're seeing a little bit of an uptick in markets like Queensland, I think it's important to now look at the different quartiles, Ali, just so that our listeners can understand. When you hear the media saying, Sydney's gone back 0.6% or 1%, well, what does that really mean? Well, typically speaking, what they do, everyone, is they have what is called a quartile segmenting. So, if we look at Sydney, whilst the overarching graph mentioned that Sydney's gone backwards, and it's gone backwards by 0.2%, in reality, if you look at the affordable quartiles of Sydney, which is the 25th and the 50th, so the affordable price points or segments in the market, have seen a positive growth of 1.8% and 1.1%. Now, what's really interesting, and maybe Ali, just take us through Brisbane, Adelaide, Perth, etc. markets, how these have performed, and what sort of price points do these quartiles reflect for those markets?
Yeah. So when we look at what we're looking at here is Brisbane as an overall, and saying the cheapest, I guess, 0 to 25% of property values, or 0 to say 50% of property values, in the orangish color quarter. Then we go 50% to 75% worth of property values. So let's just say we got $1 million median price, or so say, we're talking about a certain price point, and we go properties that are under 500K, 500 to 750K, and then 700 and say $1 million. Let's just say $1 million was the most expensive market. What we're seeing here, and we've seen this time and time again, is that the lower price properties, right, in each of these markets. So when we look at the 25th quartile of property prices in Brisbane, grew by 6.4%. The 50th, or the middle quartile of property prices have grown by 5.7%. And the growth in the 75th percentile have grown by 3.9%. Now, all very strong signs of capital growth. However, we're seeing almost double the growth in the more affordable markets. And why is that? It's more affordable for first home buyers, which is probably the people that are generally can push prices, more people that can afford it. Also, investors that are entering these markets are looking for more affordable markets that relatively have that yield to support it. When we look at Adelaide, it paints a very similar picture. 4.2% in the cheaper 25th quartile, 4% in the 50th, and 2.9% in the 75th in Adelaide. So Adelaide, that 25th and 50th is probably very tight between the two. But I think where Perth gets into the market actually shows a bigger sign. of the difference in the deviation between this 25th quartile price points at 9.2% growth in the market, whereas the median was 7.9, and then the 75th quartile price range was 5.9%. So 5.8. So you can just see there that, again, the cheaper value of property prices have had the most significant growth. And across the board, when we go back and to look at, say, Sydney and Melbourne, they paint a very important picture, like you mentioned earlier, Roy, that the 75th quartile price point for Sydney, and this debunks a lot of these property guys that talk about buying in the eastern suburbs or in the most expensive areas, because the wealthy people are always the ones that are going to be able to afford the property, or the lifestyle properties that are super expensive, they'll always continue to grow. It's actually shown us the opposite. Funnily enough, the 25th quartile price point have actually grown 1.8%. Now, when we annualize that over 4 quarters, we're actually going to see pretty good signs of capital growth. It's still going to perform above, based on this, over 6.8%. So it's actually going to be performing above the national average. But if we annualize the negative growth of 1.8%, we're going to see close to an 8% decline. So in my opinion, right now, if I had money and I was looking at buying a, very expensive property in the market, thinking I was going to get a discount, right? I would just say that when it's bleeding, when a cut bleeds, it doesn't stop straight away. It takes a bit of time in order for it to heal. My opinion is we've only started the bleeding. I don't expect major, but when there is very low sentiment in the market, especially with, the higher, more expensive properties, I would say that it will continue a little bit. So I would probably hold back and be prepared to negotiate, and for buyers and for sellers to be prepared to meet the market, as our mate Tom Panis always would say, meet the market. So just good sign for people to know.
Now, okay, well, this quarter looked good. Last 12 months looked great. We've got the interest rates rising. We've got the war. One thing that we might be worthwhile touching on is the supply, the expected supply over the next 6 to 12 months across the board. So I'm just going to put this on the screen so we can go through it. Page 30 in the report. Essentially, for us to be able to understand the actual supply that we are going to have, it's good to take a step back even further and look at the number of approvals. Can you take us through that, Ali?
Yeah, so it's saying that Australia has recorded, 196,491 dwelling approvals in the last quarter, 8.6% higher than the 12 months prior, but well below the 240 annual target implied by the Federal Housing Accord goal of 1.2 million houses. So I guess what we have seen is that essentially the market's picked up in approvals from where it was, say, give or take 12 months ago, but still nowhere near where we actually need. So it's maybe a little bit of a sign that that we're heading in the right direction in terms of building new houses, but we're still below the current target. So that's good, but I will lodge one caveat here and state that, truth be told, because we do quite a lot of purchases, Roy, and one thing that we've always pride ourselves on is that we do all types of property purchases, because I think that there's a strategy for every single investor. And we do a lot of brand new purchases, as well as obviously a lot of established purchases. And what I have been told, in each market has its own strategy. But right now, something that I've been dealing with has been dealing with a lot of our wholesale builders, and prices have gone up significantly. Actually, builders are getting quite cautious to build. Builders are a lot smarter than what they were around 5 years ago, before the COVID period, and granted that they are the ones that have survived. They're very cautious on when they start to see these global issues and how it affects trade and supply. and they've put their front foot forward. I'll tell you that. They've put contingencies in place. They've put price rises in places. They've put forecasting in places. A lot of the builders that I work with that have survived during this period of time, during COVID, have forecasted. And they're sitting in board meetings and talking. Prices have risen. In some cases already, we've started to see build costs increase by 5%. And that's just build costs alone. So the one thing that I see is, unfortunately, during this time, this is exactly what happened during COVID, was that there were less homes being built because prices went up. People were uncertain on the current climate, so they're less likely to build, which is, watch this space, because the capital gains, the negative gearing and tax relief, I think is going to be a bit harsh and tough to the average investor. But to people that build new homes, there will be some tax relief and tax cuts. And I believe they're going to incentivize people to build new properties. South Australia has already come up with abolishing stamp duty for new homes, which is crazy. And there will be a couple of things there. But in the current climate, I genuinely believe that people are going to be scared, rightfully so. Builders have gone under. Builders are more expensive as well. So I think that even though we made a pretty good progress in the last quarter, Roy, in terms of building homes, I don't see that continuing to continue to grow above the average. In my opinion, I would say that the next 3 months will probably be a little bit slower for the new housing market.
Okay, so Ali, let's just say I'm a first-time investor. I bought my home, and I'm a first-time investor. What is your advice to me, considering the charts that we went through today, considering that there's a lot of chatter in the media, on socials, a lot of different opinions and so on? What's your advice to me?
My advice is, number one, understand your capacity. I would say getting into the market now while there are opportunities in people being uncertain, especially coming up to the federal budget. I would be focusing on a market in the affordable price points. I would be focusing probably more on established properties in the current market at the moment. Things that essentially are solid properties, brick homes. I would be getting into the market. I'd be creating buffers, and I'd be focusing on some of those markets there that are showing good signs of capital growth, and just finding a property that meets your long-term goals and needs.
Awesome. That's it from my end. Do you have anything else you'd like to add?
No, I think just, guys, keep in mind that property investing is a mental game. Even someone like myself who's bought, over 60 properties, it still has certain, thoughts. Obviously, when these kind of things occur, is it the right time right now? Can we hold off a little bit longer? But understand that property is a long-term game. And when I say long-term game, it doesn't mean you just buy a property and you set and forget. You have to understand the data, short-term. Something that I've learned recently is the difference between having short-term compounded growth over multiple properties is a lot better than having a property that doesn't perform well in the short term and then performs really well in the long term, because the compound return is so much greater. But understand that property is a mental game. Things like this are going to come up. Stay on the course. The most successful investors have learned that during capital gains changes, Roy, negative gearing changes, wars, COVID, all these things. And I think there are graphs now for days. So for those that are thinking about investing and are now starting to question themselves, educate yourself and understand what happens during these global issues or situations like this. Stay strong-minded. Keep focusing on your end goal and adjust and pivot your strategy if need be, but make sure that it's still along the lines of going towards your goal, and don't completely, throw in the towel and then sit on the sideline, because these are the moments where the right investors take as much opportunity as possible to get themselves ahead and ahead of the rest of the market as well. So that's my advice.
Awesome. Oh, thank you so much for listening, everyone, and for watching. For anyone on YouTube, thank you so much, Ali. I'll catch you again in the next one.
Thank
Have
you.
A good one, mate. Good luck with the push-ups tonight. See ya. Bye-bye.